When a borrower defaults, what is your collateral actually worth? In traditional finance, you're trusting auditors, central banks, and illiquid markets. What if you didn't have to trust anyone, but had to survive 40% overnight drawdowns instead? In a market built on noise, this is structure. Digital credit explained. In our previous episode, we surveyed the three instrument families that constitute the digital credit ecosystem: Bitcoin collateralized lending, stablecoin yield products, and Bitcoin Treasury credit instruments. Today, we focus specifically on the first building block of this entire ecosystem, Bitcoin itself, and what makes it a categorically distinctive form of financial collateral. This is not an endorsement of Bitcoin as an investment. It is a structural analysis of its collateral properties. Collateral is the backbone of secured credit. When a lender extends a secured loan, they are in effect saying, "I am willing to take the risk of lending to you because, in the event you cannot repay, I have a claim on something of value." The quality of that claim and the quality of the underlying collateral is what determines whether the lender is genuinely protected or merely feels protected. Traditional collateral comes in many forms: real estate, corporate assets, government securities, equities. Each of these has well-established characteristics: liquidity profiles, valuation methodologies, legal enforcement mechanisms, and each has limitations. Real estate is illiquid and jurisdiction-dependent. Corporate assets require audited valuations and can be manipulated by management. Government securities are highly liquid but carry their own sovereign risk. Equities are liquid but volatile. Bitcoin introduces a set of collateral properties that are genuinely novel, and understanding them is essential to evaluating the first digital credit instrument family. The first property is fixed supply. Bitcoin's protocol enforces an absolute maximum of 21 million units. This is not a policy decision by a central bank or a corporate board. It is a mathematically enforced constraint that cannot be altered without the consensus of the entire network. For collateral purposes, this means Bitcoin cannot be debased. A central bank cannot print more Bitcoin to inflate away its value. This is a property shared by no fiat currency and few traditional assets. The second property is issuer independence. Bitcoin has no issuer. There is no company, no government, no board of directors whose financial health or governance decisions affect Bitcoin's fundamental properties. This is a radical departure from every other financial instrument used as collateral. When a corporate bond is used as collateral, the lender has implicit exposure to the creditworthiness of the bond's issuer. When Bitcoin is used as collateral, there is no issuer to default. The third property is 24-hour global liquidity. Unlike real estate, which requires an often lengthy sales process, or private credit instruments that may have no liquid secondary market, Bitcoin trades continuously on global exchanges. Its price is discovered in real time across multiple venues simultaneously. For a lender holding Bitcoin as collateral, this means the collateral can be liquidated quickly in the event of a borrower default, a property that is critical to the mathematics of loan-to-value management. The fourth property is on-chain verifiability. Unlike a corporate asset that requires an auditor's attestation or a regulator's sign-off to verify existence, Bitcoin holdings can be verified directly on the blockchain by any party with internet access. A lender can confirm in real time that the collateral pledged by a borrower has been received and is held at a specific address. This transparency has no equivalent in traditional secured lending. The fifth property, which must be acknowledged alongside the others, is price volatility. Bitcoin's value can decline significantly over short time periods. This volatility is not a theoretical risk. It has been demonstrated repeatedly. For collateral purposes, volatility means that the LTV ratio must be managed actively. The lender must maintain a buffer sufficient to withstand rapid price declines without the loan becoming under-collateralized. The construction of that buffer, the liquidation threshold, the margin call mechanics, is one of the most critical engineering challenges in Bitcoin collateralized lending. These 5 properties, fixed supply, issuer independence, continuous global liquidity, on-chain verifiability, and meaningful price volatility, define Bitcoin's collateral profile. The first 4 are structural advantages over many traditional collateral types. The 5th is a structural risk that must be rigorously managed. A sophisticated evaluation of any Bitcoin collateralized credit instrument begins by assessing how the structural risk of volatility is addressed through the instrument's design. Bitcoin's properties as collateral are not simply different from traditional collateral. They are architecturally novel. The combination of fixed supply, issuer independence, continuous liquidity, and on-chain verifiability creates a collateral profile with genuine structural advantages for secured lenders. But volatility is a real and significant risk that must be incorporated into every evaluation of Bitcoin collateralized credit. The analytical discipline is to hold both truths simultaneously, novel advantages and non-trivial risks, and to evaluate how each instrument's design manages the tension between them. In the next episode, we trace the mechanics of Bitcoin collateralized lending from origination through the life of the loan, including what happens when volatility tests the collateral cushion. Clarity before yield. Always. Digital Credit Explained.